All right, we're going to get rolling.
They helped create an economy that was completely addicted to cheap money.
You need to buy savings bonds or something. You need to be way, way, way out of this space.
I subscribe to Miss Piggy's rule of money management. Always manage to have more money, you know what I mean?
It wasn't but 2 years ago that everybody was saying China's economy was going to be bigger than that of the United States. It's gone in the exact opposite direction.
So we're going to jump right in.
Welcome to VRIC Media, the most trusted voice in junior mining. And I'm joined today by Adam Taggart. Adam, it's great to see you and get you on the program.
Thanks, Jay. It is a pleasure to be here. I got to go to your VRIC conference early this year. It was wonderful. You run a great operation. I'm very pleased to be here.
I'm glad you're coming back this year, January 1920. It's going to be another barn burner, so I'm looking forward to that.
Thanks, it should be. And, you know, getting to sit on stage with you and Brent Johnson and Danielle DiMartino Booth and Danielle Park, who I actually hadn't known before, but I've since interviewed her a couple of times since. Just such a great opportunity to share thoughts with such a great brain trust that you assemble there. So, you'd have to beat me away with a stick to get me to not come back this year.
I love that. Okay, so, Adam, when you look at the assumptions that investors might be making today about economic forecasts or market performance, et cetera, do any stand out to you as blatantly misunderstood? Like, here's what everybody's thinking and here's what they're missing. Does anything stand out to you right there?
Yeah, I'd say there are probably a couple things that I think are misunderstood right now. We'll put it that way. And maybe I could start from a high level. I just had my own conference. I do 2 online ones a year and sort of opened this most recent one with the statement that if you're not confused, you're not paying attention. And the reason why I say that is, like you, Jay, my day job is interviewing a lot of top minds and money in the markets. And usually on most issues, there's sort of a general consensus. You know, not everybody agrees, but more often than not, a preponderance do, about directions of the markets, the economy, policy, whatever. And right now, I am seeing more disagreements on a couple of key elements than I ever had before. It's almost kind of split 50-50 down the road. One is the direction of inflation, and kind of tied to that is the direction of bond yields and bond prices, because in many ways, they're a function of inflation expectations. So we're at one of those moments in markets where really smart people can look at the same data and come to quite different conclusions. Mm-hmm. So, if you're an investor who's been sort of, listening to lots of channels like yours and mine, and you're having a hard time trying to really pin down, some of these key issues, it very well may be because, like I said, really smart people can make really compelling arguments either way here. But I think I think probably related to that is, I think there's a growing consensus that we somehow got out of, amongst investors in general, that we somehow got through all of the massive deformations of the unprecedented stimulus of the COVID era, without really having to pay a price for that, or really having to deal with longstanding repercussions from that. Narrative has shifted to soft landing / no landing, right? Federal Reserve hike interest rates more aggressively than it has in our, living lifetime, Jay. Mm-hmm. And yet no recession materialized from that higher cost of capital, right? So I think there's a strong sense of the status quo is very resilient and it's just going to keep on going. And I would say, be very careful about that, because I think actually when you look at what's happening right now on the macro stage, the game is changing. It's changing in many different ways. Obviously, very clearly, we're going to have a new U.S. president in a week. Hopefully, hopefully it's not a super contested election. And that's going to obviously, come with new policies. Whoever wins, it's going to be a new president. They're going to have new policies they're going to implement, and of course, those, depending on who wins, those policies could be quite different. But we are in a new regime for interest rates, right? After several years of aggressive interest rate hikes by the Fed and a lot of its other brethren central banks, pretty much all the world's major central banks now are back to cutting interest rates. Interestingly, the bond market is starting to push back on the central banks, right? So we've seen the Fed cut interest rates here and what's happened since. Bond yields have gone up on the long end of the curve. Mortgage rates are back up, right? So that is different. That hasn't happened in a long time. Valuations are at really rich extremes right now. At the same time, when consumers are increasingly tapping out. So this just raises the question of, kind of how high do trees grow, right? They don't grow to the moon. Trees don't grow to the moon. Valuation multiples can't just keep increasing forever unless there's some fundamental reason for that, right? But PE multiples are growing much, much faster than actual earnings are at this point in time. And then lastly, we're seeing volatility return, both in the stock market, as measured by the VIX, but also in the bond market as measured by the MOVE index. So there's lots of changes that are happening here for folks that are paying attention. And kind of each one of those that I mentioned has the potential to have real implications, both for either economic growth and or where asset prices are headed in the future. But I think, to the spirit of your question, I think a lot of investors here are just saying, look, we had a great 2023. We had a great 2024. Everything looks great right now heading into 2025. I just think I'm just planning for this status quo to continue. I kind of liken it to the person whose team won the World Series or the Super Bowl the previous 2 years. And you get in this mindset where you just assume it's going to be a three-peat, right? Not realizing how statistically improbable that is. And even if, I'm not saying the wheels are going to come off from the markets or the economy per se in 2025. They could, and we could talk about that. But I do think, just like if you're used to your team, getting that title ring every year, and year three comes along and they make the playoffs, but they don't go win the championship, you're disappointed. You set yourself up for disappointment. I think investors in a similar way are setting themselves up for disappointment next year, even if we still have an up year in the market.
Okay. I want to pick this apart a little bit. So thank you. That was very comprehensive. We jumped into a lot of buckets here. Now I want to maybe subtly pick on various, but maybe where I'll start before I get to that, I want to jump into your inflation comments and the bond market comments. You mentioned a couple of things that make me think that the passive approach is no longer applied. And you shared this with me before we hit record here, that it's the active strategy that might be the winning one moving forward, which means I interpret that, Adam, tell me if I'm on the mark, is people have to be a little bit more accountable with their decisions in the market right now because there's too much uncertainty in too many places. Is that accurate? What's your take?
Yeah, I think that's totally accurate. And there's obviously the uncertainty is a big reason for that, and that generally implies more volatility ahead. I mentioned volatility started to rise. I think there's good arguments to be made for more volatility ahead. In a volatile market, obviously an active strategy works much better than a passive strategy. But probably even just at a very high level, Jay, back to my comments about valuations. When multiples rise, when valuation multiples rise, like PE ratios on stocks, essentially what you're doing is you are pulling tomorrow's prices into today, right? When you're doing that.
Yeah.
And valuations have risen to such a rich level that many analysts have been increasingly saying, look, based upon, historic times valuations got this stretched, the next decade had subpar returns. And, you've had people like John Hussman, who tracks this specific issue extremely closely, and his charts for a good while now have been saying that the expected returns over the next 12 years are likely going to be negative. But some people might say, well, Hussman, he's a bear. I mean, John doesn't think he is, but people can try to paint him with that brush. But then just recently, you probably saw that Goldman Sachs came out and said that it looks like market returns should average about 3% for the next 10 years, which would be extremely disappointing versus what folks have enjoyed largely following a passive strategy in the past. So when you get to a point like this where forward returns look like they're going to be so insufficient, disappointing, it doesn't mean, let's say Goldman Sachs is right and the market averages 3% for the next 10 years, right? It doesn't mean that it's just going to grow at 3% a year for the next 10 years. What that probably means much more realistically is you're going to have some years where you get superior growth, a couple years where you get some just gut-wrenching drops in the market, right? And that's where an active approach can really deliver a much superior return over time. Because if you're able to, hedge and lighten up and take precautions when things get too stretched to the upside, you then have dry powder to deploy when things get stretched to the downside. So you can enjoy, maybe a several multiples better return with a successful active approach than simply holding the market if we are indeed entering, a decade like an increasing number of the analysts think we are.
Yeah. Okay. Now, one thing, so that's really fascinating. I didn't know that Goldman comment because, we hear individuals make that claim quite often in your and my circles. People like Luke Roman and Grant Williams and, very successful investors, but that's a statement that is often disputed by the mainstream, right? And then you hear a platform like Goldman come out and say, look, actually what we're forecasting is an average of 3%, which might be 6% year one, 0% year two, exactly all over the map, but averaging 3%. However, you can't really default to an active strategy the way you can default to a passive strategy, right? Because active by design requires a lot more decision making and therefore the ability to make mistakes, right? And so how armed do you think the average retail investor is to just okay, I'll get active and then make a pile of poor decisions? What's the approach maybe that one should take in that scenario, Adam?
So I'm so glad you asked this question because this is where I was going to bring it if you hadn't, which is because of all the interventions that have been happening in the markets for the past 20 plus years. I mean, really for pretty much the majority of your and my investing lives, Jay, is the interventions have lent both an artificial tranquility to markets as well as an underlying bid that has just been a tailwind for asset prices, right? So the passive approach has worked really well, and it's been easy. It's been the easy button, right? What do? You go long, What else do you have to do? Not much else. Oh, buy the dips. Right? So you go along and you buy the dips, and over time, the Fed and the central planners will take care of you, right? So it's been, investing the way of the easy button. And we have trained investors. That's the way to do it. In fact, we've kind of punished them, right? For folks that took an active approach, a more conservative approach, they generally underperform the markets, right? You and I probably know lots of stories of people that got out, maybe even got out back in 2008 and still haven't been able to buy into the market, right? They still talk themselves out of it because of how high valuations are, and then valuations go even higher, right? So I think the central planners have done a huge disservice where they have provided a perverse incentive for people to not educate themselves on how to invest. They've literally just learned to ride this artificial wave. So the question is what happens when and if that wave no longer works the way that it did, right? And then an active approach is required. I mean, to be honest, I would say the majority of investors, especially on the retail side, but I'd lump the majority of professionals in there as well. They've got to go back to school, right? So you're absolutely right. You can't just jump into a sport that you haven't played and be excellent at it, right? You have to have your, your boot camp of learning the ropes and getting beat and making lots of mistakes and learning from those mistakes, right? So for most people, what I recommend they do is recruit the help of a professional, at least early on. At least as a sounding board. I mean, if you're a DIY investor and you've had a majority passive strategy, you're not willing to give the reins yet to somebody else, but you haven't done much of this yourself. Pay somebody on an hourly basis, a fee basis, just on an hourly basis to say, hey, help me craft my strategy, or hey, I'm putting together my strategy. Let me run it by you, right? But I think for most people, at least most regular investors, they don't necessarily have the time, the bandwidth. If they're honest with themselves, as we're talking about, they might not have the skill set yet, right? Yeah. So, look over somebody's shoulder for an hour, for a year or two, have rather than focusing on, okay, what's the next best asset to put in my portfolio? Maybe focus on who's the best person to manage my money, or at least a percentage of it, so that I can get the benefit of their professional active management expertise. And then if I want to, I can start copying that, learning from it, and clawing more and more of that back under my own DIY umbrella going forward. But I think I do think, Jay, that if this increasing number of analysts are right, and we do have more turbulent times in the market ahead of us, I think the collateral damage is going to be really high because we have basically, forced the majority of our investing base to develop muscles that are going to be the wrong ones to use for what's ahead. And then the muscles they're going to need are going to be, highly atrophied and unused. I think a lot of people are going to get caught unawares by that.
Do you think that is as simple as a cyclical market correction? So we've been trained to invest a certain way because of recent performance. Stimulated as it might have been, we see these corrections, 87, 2008,
Yep.
87, 2001. Yeah. 2008, 2020, a bit muddy there because there's a lot going on, but
I'm sorry. I meant 2022, but yeah. 2020 is a little bit of an outlier. Yeah.
Yeah. We're kind of due every decade, right? For one of these major corrections. Is that the cycle that you're pointing to as the old skills might not apply, or is there a bit more at play today? Because we're also entering the sunset years of a lot of empire symptoms, right? Including the strength of the reserve currency, the trade currency, rising blocks of competitiveness, like a whole bunch of stuff going on now that's not a 10-year cycle. It's more like an 80-year cycle, right? And these move really slowly, but they're very significant. And we see this with repetition. I mean, we've had 5 reserve currencies in the last 600 years, which gives you a bit of a sample of the expeditious nature with which this system changes. And we're getting close to those. It's impossible to call that. But so my question is this like when you say the muscles we've developed might not apply to the future, is this the muscles of the last recent bull market, or is this the muscle of the sort of bigger macro trend of world order and what may fall out in a new uncertain?
Yeah, it's a great question, and I know that it's a question that those larger concerns you're raising, those big cyclical ones. I know they're ones that a lot of our viewers grapple with and worry about. I'm not trying to cop out, and I'll explain why. But my short answer to your question is both. I think their muscles are unprepared for both environments, and honestly, probably everybody's muscles are practically unprepared for some of the big sort of fourth turning type of things that you're talking about. Just because none of us have been alive, since the last one, right?
Yeah.
I think what matters more in the near term is the form of what you talked about, which is just, hey, look, if the easy tailwind that we've returned to enjoying since the end of 2022, if that starts becoming more turbulent, I think it's going to catch a lot of people increasingly out of position, right? So I think if you're just saying, look, I'm looking forward to the next year, I'd say that's what you should worry about. I'm right there with you, and we could talk the whole time about any one of those big trends, loss of reserve currency, sovereign debt crisis, the social upheaval that comes with a Neil Howe style fourth turning. The thing I would caution people is those things take a long time to play out, and just be something you're going to hear me mention through the rest of this conversation probably is hedging, right? Which is whatever your primary thesis is. Make sure that you've got some hedges in place in your portfolio in case your primary thesis doesn't play out over the timeline that you're hoping or needing it to, right? Because what I've seen a lot of times, I've never been at this for close to 15 years, Jay. I know you've been in it for a while too. I've seen lots of people take drastic action in their portfolio because of some of these big cyclical fears of sea change fears, and that oftentimes it takes a lot longer to play out than most people think. And even when it starts, it's not something that happens overnight. It happens over many years, maybe decades. And so I've seen people take extreme positions, and they might be proven right in the next 5, 10, 20 years, but they can get wiped out multiple times along the way just by the regular up and downs of the system still continuing to work more or less like it has. So I would just I do think that increasingly we as a system will start to hit into those big major issues you mentioned, and I think the system itself is unprepared for them. And generally, the way things tend to work there is the system resists, right? Remember, every player in power in the system is trying to keep the status quo going, and that's one of the reasons why it can last so much longer than we think. You really, I think, want to wait until you see real big visible cracks in the system, the banking system starting to really freeze up. Things like, for sure, credit spreads blowing out in ways that we haven't seen for years. Real signs of systemic stress like that before you make any really big bets on some of those major calamities that you referenced.
On the topic of hedging, Adam, can you walk me through what that looks like in your portfolio?
Sure. And let me give a little shameless plug here, but it might help folks. There's a video that I've had some of the financial advisors that I work with over at Thoughtful Money that kind of walks through the basics of hedging. So I'll give a short answer to your question, but if somebody wants kind of a deep dive into this topic, just go to thoughtfulmoney.com/hedging and you can get, I think it's got a 45-minute video that goes into sort of the most common ways in which people can hedge their portfolio against risk. Hedging essentially, I think the way to think about it is like insurance, right? You don't want your house to burn down. You're not rooting for that, but you buy home insurance on the off chance that it might and that you're protected against some calamitous loss, right? So you look to hedging as basically a way to protect your portfolio from downside risk. Lots of different ways to do it. The simplest of which is just to lighten up on your exposure, right? Moving more increasingly to cash if you're worried about where markets are. That's a very simple, easy way to hedge. Lots of other instruments, everything from stop. Diversification itself is a good hedge too. If you're in love with a trade and you put the vast majority of your portfolio in it, you are highly vulnerable to where that trade goes in the future. Just having some, smart diversification in some other different asset classes can give you a lot of protection, again, in case your primary thesis doesn't work out the way that you thought. I would say one of the primary ways that I do it, and I'm going to be super clear, I do this largely through the advisors who manage my money, because I don't have the time nor the level of expertise they have to do it, is where you have large positions in your portfolio. Like I've got a pretty, relative to the average investor, I've got a very large percent exposure to the precious metals, right? And the mining companies, very volatile sector. And actually it's a great example for this question, because if you've been a precious metals investor over the past several years, you know what a great run that we've had over the past year right now. Gold's at an all-time highs. Mining complex is waking back up. Silver's starting to really move here. You probably enjoyed some pretty good returns in your portfolio over the past year. Now, if you've held on for a while, this is a really volatile asset class. So the odds of this thing going through, kind of a brutal pullback, not terribly small, right? And you can either choose to do nothing and ride 100% of that pullback down if it happens, or you can put a little bit of your capital at play and buy some protective puts, right? And if the market goes down, you've got protection below a certain level that, depending on how you structure the puts, a percentage and hopefully a meaningful percentage of your position will get protected if the market drops below, or the price of gold drops below a certain percent or certain price. Now, if you're wrong and gold just keeps going high from here, you're happy, because you only laid out a certain amount of your, small amount of your capital for the insurance. And just like you're happy when your house doesn't burn down at the end of the year, you're happy to let that insurance expire, at zero, because you're sitting on additional gains in your core position. So a lot of people haven't used options much, Jay, and this is, again, one of those really good examples where I think, look, until you become really proficient at it and decide you really have a desire and a talent to do it for your portfolio, leverage the expertise of an expert on this. And there are plenty that know how to do this really well. And, if you just want to work with them for the insurance part, they're happy to do that. They don't have to manage your entire portfolio for you.
I completely agree with that. Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the two most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake gold mines. Hit the link below to learn more. Now back to the episode. Yeah, it's funny how often our portfolios, I see this in a lot of just my social circle, investment portfolios, people make the assumption that after consuming a couple podcasts, they can nail this, right? They know what's going on. They can make the decisions. It's kind of like you watched a season of the NBA. Well, guess what? Then you hop on the court, like what happens, right? It's not enough, you know?
You're not LeBron. Yeah, exactly.
Same thing. This is a competitive market. And I always stress that to folks when they ask me about, maybe that they're newer to investing, newer to building a portfolio. And I say, just remember that this is competitive. Like you're in a competition with everybody else who's trying to find capital gains. So unless you think you can outcompete everybody else, like, on the court, really question what you're doing here. And even when you're buying a single share of a well-known company like NVIDIA, you're buying a share of NVIDIA, you're having a disagreement with somebody because it's an open market. Somebody is selling you that share. And so exactly. You're saying, I think this is undervalued and going to go up. That's why I'm buying it. But there's somebody else who's saying, I think it's overvalued and going to go down. There's a competition occurring, right? And unless you can honestly tell yourself what you think that person probably doesn't, you're just gambling at that point, unless you can have that honest conversation with yourself.
Absolutely. As you know on this, Jay, the arms race that has grown up around the financial industry is massive. I mean, it's so large that there are components of it that work in ways that we as humans just can't understand, like the speed at which high frequency trading algorithms trade, right? They can trade a lifetime of human trades in the blink of an eye, literally.
Yes.
Right. So there are just tons of professionals out there who have much more information than you and much more of these type of tools that give them a great advantage. And so honestly, I think it's a little bit of hubris. I mean, it can be done, but it's a little bit of hubris, to say, look, I'm going to consistently be able to pick, individual stocks that are going to, where I found the market's got a core undervaluation and everybody else is wrong and I'm right, right? Very smart people can do that if a certain amount of times. Regular people can get lucky at that once or twice, just like you can walk into Vegas and get a hot hand, right? But I think most investors are much better served by looking at investing like a game of football, right? Where it's not about throwing Hail Mary passes every play, right? It's a game of yardage, right? It's like, look, if I, have a good diversified portfolio, if I do enough macro, analysis to understand the probabilities of which sectors are likely to benefit in this market cycle, if I look at valuations, and so I'm making sure that I'm not, paying crazy amounts of value for the companies that I'm going after. There's a lot of just kind of basic blocking and tackling. A big one being too, this is also sort of another version of hedging, if you will, is, position sizing is one of the things that all great portfolio allocators really emphasize, which is, you should build a diversified portfolio. You should know what you're holding, why you're holding it, and you should have a target percentage of your portfolio you want to have in that. And if that stock runs, right, let's say you got a great, gold mining company and it goes bananas, you want to then trim back to your original portfolio allocation. Take those gains off the table. Take them from theoretical gains to real gains, right? Because what a lot of people do is they've got a winner. They think they're a genius. They hold on for it too long. The market corrects and they're realizing, oh my God, I had this amazing win and now I'm actually stuck at a loss here, right? So when you learn sort of the time-honored collective best practices that most capital managers have used to build wealth via yardage over time, then it's not trying to beat everybody with every trade you're trying to make. It's just trying to make smart trades that will get you those yards, on average again and again going forward. And if you do that, then you can the math begins to become pretty easy. Okay, what are my financial goals? And if I get X yards a year, when am I likely to actually get to my destination? I think regular retail investors are much better taking that mindset than, hey, I got to be the smartest guy in the room, because by definition, not everybody can be the smartest guy in the room. Only one person can be.
That's just like generally good life advice, isn't it, Adam? Like,
I think so, yeah.
It is. Like, of course, we always want to swing for the fences, and sometimes, just through probability, you get that home run, right? As Bezos calls it, at bats, right? It's No, it's just about how frequently can you get back to the plate. But if you bet more than you can afford to lose, you're out of the game. That's kind of the idea there, which very frequently occurs. People don't de-risk, as you mentioned. They have an idea, they allocate some capital. Their idea turns out to be right. So their conviction goes up. I'm right. I'm smarter than I thought I was, right? And so instead of de-risking and taking some cash off the table, back to your precious metals hedging statements a few minutes ago, right? Had a great run in the gold and the silver market. Maybe it's time to de-risk a little bit. I want to pull on that a little bit. So actually, let's go there now. First, I'm curious how you invest in the precious metals sector, because when I heard you say it's been, a great year in precious metals, I could have two answers to that. I could look at the commodity prices and say, yes, absolutely. Or I could look at many of the not necessarily the producers, but the developers and the explorer equity prices and say, it's been a really tough year. It's been abysmal, right? We've seen the gold price and silver price rocket, and a lot of the equities have not performed yet. So when you talk about precious metals exposure, what does that look like in your portfolio?
Sure, great. And one thing I should mention just on our general theme here is, I run a macro channel. I interview, at least 4 experts a week on what they think. And a lot of people look to me and say, oh, well, you must be, a super informed investor. And I like to think that I am a super informed investor, but I don't manage my own money. And I don't manage my own money because I want to make sure that my financial team and myself are focused on our centers of excellence, right? I'm much more of an educator, much more of a media guy. My job is to help the regular investor get the best understanding of what's in the brains of the experts that I interview. That's my talent. My talent isn't necessarily building the most optimal portfolio. I want to bring in the pros to do that for me so that I can focus on my center of excellence and they can focus on theirs.
Appreciate that.
Okay, so now to the question of how I build exposure to precious metals. So in general, I think everybody, I'll tell you what I did over time and then I'll tell you what I've been doing this year. You start by building your own, whatever you want to call it, Armageddon insurance, right? And this is physical metal that you can get your hands on very quickly, right? Don't necessarily need to keep it in your house, but somewhere local where you can get your hot little hands on it, in an emergency, should you need to. Only you can determine what the right size of that is. And the rule of thumb is, have as much as you can still sleep well at night, with, but you don't want to have too much because then it becomes either a theft risk or a loss risk, right? Above and beyond that, if you still want to have exposure to physical that you can get if you need to, but not necessarily within minutes, that's where the storage options come into play. And I'm sure, Jay, your audience is probably familiar through you of some of the very good companies that do that, right? So that's what I kind of call like your core investment in precious metals. Now, if you think that, and again, I'd say for most people driving that, it is emergency wealth preservation, and that is sort of like protection against a currency collapse. I don't think that's likely to happen. I think that the purchasing power of the dollar and all world fiat currencies is going to continue to erode from here, and probably at a faster rate than it has in the past. But I don't think you and I are going to wake up tomorrow, Jay, and basically, see the dollar, in complete crisis. I think it's going to be a process, not an event. But in case I'm wrong, right, I'll wake up tomorrow with more ounces of precious metals than 99.999% of people out there, right? And you don't need to have a lot of ounces to make that happen, right? As you know, the average U.S. household probably has no ounces. So anyways, you have that at the start, then you graduate. If you want to still have more metal, but not keep it at your home, look at one of the vaulting solutions. Just make sure you're doing it on an allocated basis and not a pooled basis. I'm guessing your audience knows the difference between that. Now, if you then think, hey, I think that the precious metals prices are likely to go up from here for a whole variety of different ways, and you have additional capital that you want to put into practice on that, that's where the paper gold ETFs and the mining stocks come in, right? If you just want to speculate on price, own the ETFs. If you want to, really try to, get leveraged exposure to the price, obviously then own the miners. And I'm sure your audience knows well the difference between the majors and the miners and the producers and the developers and the explorers. So I won't go and explain all that. But I think, what I do is I own all of those, right? But that's the order in which I built my exposure. Right now, if you're buying in the mining stocks, and yeah, mining stocks have not caught up with the metals by any stretch, but they are showing life now, Jay, right? Right. The GDX index is certainly higher than where it was when it started the year at this point, right? So we're seeing the beginning of momentum from here, right? So, what I have done is I've captured some of the beta, right? So I own some of the major ETFs in the mining space. But I don't have a ton in them. And the reason for that is I like the RIC rule strategy, which is, it's a highly volatile space. When you own the ETFs, you own everything. And there's kind of a lot of dogs in there, right? It's mining. There's a lot of uncertainty, right? And he says it's not that hard to pick out the diamonds. So if you want to own GDX, which is the majors, right? Well, again, you're owning all the majors. But there's definitely some world-class companies there. The Wheaton Precious, the Franco Nevadas, the Agnico Eagles, et cetera, where, if you just own the diamonds, you're likely to have a much better longer term return because they're not getting dragged down by all the dogs there. You're still capturing a lot of the beta of the diamonds without getting the negative beta of the dogs. And then when it comes into the getting down lower in the stack in terms of more junior companies, again, this is another instance in where I say, look, unless you've spent a decade or more following this industry and you've gotten on a plane and visited mines and you've got personal relationships with the executives that manage these companies, you're highly better off following somebody who does. And there are great people out there, many of which who go to your conference, Jay, who that is what they do, right? And so a lot of them, have great newsletters that you can follow. You can literally look over their shoulders, follow their trades. They'll tell you what they're buying, why they're buying it, and then you can decide if you like it or not and add it to your portfolio. So I definitely follow several people when I get down to more of the junior mining companies, where I'm not making the pick myself. I'm looking at these guys and saying, who do you think is the best of what's out there, and going with their expertise.
Very, very important, and like a core role. And actually, all my students in the commodity university, exactly what Adam just discussed when you walk through sort of the value ladder inside the precious metals, from owning physical to the explorers. And for anybody who's looking to increase their knowledge base in the commodity sector, go to thecommodityuniversity.com and join thousands of students right now who are, increasing their arsenal of knowledge in this business, which I think is very opportunistic right now, Adam. I'd love to know what you think about this, because when we were talking about, not everybody can be an expert. You can't just become an expert at managing your portfolio. It's very hard to do. And this game will wipe you out if you're not paying attention. People look at the market like a get rich quick scheme. It's not. It's a go broke fast scheme for most people, but it's a get rich slow scheme if you have patience and you're willing to do the work. But that aside, I only go where I know I can outperform. Back to the competition element. Like, I want to get in the arena where I have a competitive advantage. If I'm playing with my money, I got 3 kids. Like, it's important to me that I'm protected and I'm playing with an advantage. And one opportunity that the mining business presents today is that it's a very uncrowded arena, right? You want to go gamble on overvalued tech stocks, you're competing with millions of people, right? It's a huge landscape. There's a lot going on. Go to the quiet corner of the room where there's only a few people having a conversation, and, you can climb that ladder a lot faster. And I'd love to know what you think about that, because it's still the mining business, the precious metals business, still a very unloved sector, and easy to hate on, but it's where we get our raw materials from. It's absolutely necessary. And, what's your take on that, Adam?
Yeah. So, I'm right there with you on all that. I think, again, Rick Rule, he says, look, I don't like to focus on what's loved. Don't tell me about what you love. Tell me about what you hate. Because he basically has made the vast majority of his money investing in sectors when they were left for dead, right? When nobody wanted to touch them, right? So I totally agree right now that, there's a lot of untapped opportunity here. Now, you and I can talk about, the evolving geopolitical situation. We can talk about, the ongoing, loss of purchasing power in fiat currencies. I mean, there are all these big macro tailwinds that should be very positive for commodity prices going forward, right? Yet, I'm sure you've seen the charts of commodity prices to the S&P, right? We're still kind of at a historic low in that ratio, right? Which again, I think investors like Rick Rule love to see, right? Because extremes are called extremes for a reason, right? They eventually revert, right? And you can make a lot of money on that mean reversion, right? And I think one of the things that's particularly interesting about the precious metals complex right now is, do you remember when Grant Williams wrote that piece? God, it was 8-9 years ago, titled "Gold Nobody Cares."
I do.
And
Yeah.
and he was basically talking to guys like you and me who were in the gold trade for all the reasons that we're in it right now, right? And he said, "Look, you're probably right. The problem we have right now is that nobody cares, right?" And what's interesting is since he wrote that piece, gold had a lot of rough years in between 2012 and, just a few years ago. And, investors just didn't care. Now, in recent years, central banks have really started caring, right? They've really started swapping out sovereign debt, namely US treasuries, on their balance sheets for gold, right? So they're net big buyers of gold. The Asian speculator has woken up and said, look, we can't get it, we can't get enough gold, and they've been buying hand over fist since, right? The Western investor, the Western speculator has not cared. Now we're beginning to see some initial signs, some initial positive flows into the ETFs, a few things that it's maybe beginning to catch the eye of the Western investor. And if it does, that is a massive opportunity for price here for the reasons which you mentioned. Wall Street, I think, has a bias against gold, but Wall Street has a much bigger bias for momentum and making money. And once it really starts thinking, hey, there's really money to be made in this sector, capital is going to move there. And as you know, this space, particularly, gold relative to general stocks or bonds, very small. Silver, tiny. The mining complex, infinitesimal, right? So you get this potential asymmetric upside of not a lot of percentage of capital flowing out of stocks or bonds into this space can have a dramatic positive upward explosive effect in price. And so, I agree with everything you said. And when I look at this space, I think that's kind of your competitive advantage, if you're right. Now, obviously, there's no guarantees in this world, but I can see a lot of reasons why the Western investor is increasingly going to be forced to have to care about gold. And as gold is now hitting record highs, I think Wall Street's really beginning to wake up to this and say, hey, something interesting is going on. And, it's just like an hour before coming on your show, I just published a video where I interviewed Luke Roman. And Luke is so bearish on bonds, on mid to long-term sovereign bonds. He says they're uninvestable for the foreseeable future. And let's just assume for a second his thesis is correct, that they're going to have a much tougher time going forward. I mean, Jay, if 1% or 2% of capital were to leave the bond market and move into the precious metals complex, I mean, what impact do you think that would have? It would be gargantuan, right?
Yeah, that's a David and Goliath story right there in terms of size discrepancy. Okay. As an aside, your conversations with Luke are always excellent. So I'm looking forward to that episode, Adam. You guys crush it when you're together. A few things I want to recap thus far. So we touched on the importance of having a hedging strategy, and for whoever you are, that might look different. For me, it's a larger exposure than most to physical metal, which I like to have possession of. I spend too much time with gold bugs and libertarians. I'm built that way. I like to have it, right? But you mentioned, you need to have enough that allows you to sleep well at night. I think that's what you said. And when you said that, I was like, that's exactly how I think about it. 10 years ago, when I was like single, no kids, footloose and free, I didn't need a big war chest. I was going to be okay. I mean, I could really, my performance of my portfolio or my business could really crash. The next day wasn't going to be that different for me because I was just, supporting myself. Now I got, kids, I got dependents, I got a bunch of
You're a family man. Yep.
Man, the war chest. Like, I look at it critically every year. Like, do I need to grow this? Yeah, it turns out I do. Right. And so it grows as you maybe mature through your journey. But that's a personal decision, and how you hedge might be cash equivalents, might be physical gold. But, when we were having that part of the conversation, I thought what we're looking for here in a world of increasing uncertainty, short-term or long-term, is exposure to assets with limited or no counterparty risk. I mean, that's kind of and there's other things we can put in that bucket. Some people would put Bitcoin in that bucket of like the stable, boring side of the barbell. It's quite a volatile asset, so I don't personally put it there, but I get it. It's sort of off grid. Time will tell. I'm sure you got some comments on that, but and then
I do, but let me just interject and say, as a guy who doesn't understand it all that much, I actually think you should have some exposure to it.
Yeah, I totally agree. Yeah, a non-zero position at least. So have your hedging strategy. Whatever you want to call that, your war chest. But your and then have a performance strategy. Whether that is identifying the part of the market that you can become a bit of an expert in, whether that's picking up a small sector like the mining business, or just for a lot of people, that means outsourcing your expertise to a professional to help guide your strategy. And that's the more accessible option for most people. And I would never, I run ultra marathon. I have a coach. Like, I don't even approach that on my own, right? Like, pretty much everything I do in my life that I want to excel at, I hire expertise because it's worth it and the ROI is there. So that is the path that most people should take.
That is one of the lessons of maturity, right? Is the older we get, the more that we realize, look, we're not excellent in everything, and to be able to, again, focus on our centers of excellence and then outsource the rest. Yeah. That's the recipe for success. Yeah.
Yeah. I have an entrepreneur peer group that I meet with every month for my business. I have a coach for my running. I have an investment club personally and a larger one and it's like access to resources. I pull them in as soon as I want to. It's like right away. What resources can I pull in if I want to tick the box, hit a new goal? The last thing I got to get your thoughts on this, because you talked about a shift from central bank policy, right? We're divesting a little bit from US dollar or other currencies to increase exposure to gold at a central bank level all over the world. This has been a trend for like 24 months now, increasing. I got to get your take on on just the BRICS summit, Adam, BRICS momentum, BRICS currency. I felt like the recent BRICS summit in Russia came away a bit lackluster. Like there wasn't a massive onboarding of new members. It seemed like there was actually a fair amount of disagreement about the purpose of the BRICS between countries like India that want to maybe reform ties with the West and countries like Russia, which want to break from them. And that balance might be something they have to work through. What's your take, if any, on that one, Adam?
Yeah, let me preface all this by saying I'm not a geopolitical expert, so this is one guy's opinion. But a couple of things. Look, do I think the dollar will increasingly over time experience increasing competition from other currencies, both existing and new, like a BRICS currency? Yeah, I do. Will we lose our world reserve currency status? Yeah, probably at some point in the future. Will I be alive to see it? I don't know. I tend to agree with Brent Johnson, and I'm sure you know Brent and his whole dollar milkshake theory, but he can pull up headlines from the 70s on, probably even earlier, about challenges to dollar hegemony. And he's like, look, we hear this all the time. You got to just balance it with, the rubber on the road. And in many cases, for a lot of these things, it's just talk, and a lot of what's been going on with BRICS, the concept of a competing currency, maybe one that's, priced in gold. There's been an awful lot of headlines about it, but very few actual definitive decisions made on it. I think one of the challenges you have too with the BRICS, as you sort of alluded to there, Jay, is, a lot of these countries that are in BRICS, historically have not had great relations, right? It's not like the Western Alliance where we have these, multi-decadal or sometimes centuries-long alliances. And so this is the wrong term to use, but there's sort of like how much honor is there among thieves? Like when times get tough amongst this coalition, how tight are they really going to be versus starting to fracture for each nation's own self-interests, right? So I think there's an underappreciated risk there. I caution people that say BRICS is going to release their own currency, the world is going to lose dollar reserve currency status, and that's all going to happen in the next year or two, and that's why I need to own gold or whatever. I think the odds of that are low. I think it's going to be really hard for the dollar to get displaced as the world reserve currency for two big reasons. One is just structurally, the demands that would place on the currency that would need to replace the dollar are tremendous in terms of depth of market and adoption worldwide and world payment structures and things like that. So just the logistics is really hard. But secondly, the U.S. understands it has a magnificent advantage with that, being the world's reserve currency. And it is not going to go quietly in letting the sun set on that. And there are a lot of dirty tricks that the U.S. could play that it hasn't even begun to yet to protect that advantage. And so I don't think it's something to be betting heavily on any near-term time frame. But like I sort of said earlier, let's say I'm wrong. Let's say, next month they unveil the new BRICS gold-denominated currency and countries around the world rush to start using it. I hold more gold than 99.99% of Americans. I'm going to benefit from that.
Right. Yeah, I agree with that. And I'm glad you pointed out the ideological differences within BRICS that are being overlooked, I think, to a large degree. The conversation is always as if BRICS is a nation. It's not, right? It's very fragmented. And inside of that organization, there's really serious disputes. There's a very active border dispute right now in the Himalayas between China and India that has erupted in gunfire 4 times in the last 3 years. I mean, 20 Indian soldiers and 4 Chinese troops were killed on that border in 2022. There's actually Chinese and Russian forces in conflict in Sudan right now. These are ancillary battles, but they're active, right? And so to group this nation as one is just false. And you have different goals with each. You have India and Brazil who heavily rely on trade with the West and want to maintain relations, but reform them a little bit. And then those that want them completely disrupted, maybe like Russia, maybe like China. Good takes. Adam, this has been fun. And I'm really glad you're coming back to VRIC. All the names you mentioned, Danielle DiMartino Booth, Brent Johnson, Danielle Park, Dr. Pippa Malmgren, many, many more, all coming out to the show this year. We'll have about 100 keynote speakers. We're flying in from all over the place. CambridgeHouse.com for anybody who wants to come. Check it out. And Adam, where can I point people who want to hear more from you? You publish 4 times a week. That's amazing, by the way.
Nice.
Where should I point people to today so they can hear more from you?
Well, thanks for asking. Real easy, folks. It's just thoughtfulmoney.com. If you go there, you'll see our latest content. You can get our free newsletter. And if you want to talk to one of the financial advisors that we endorse, these are free consultations with no obligation. They're just sort of a way to kick the tires to what I said earlier. Just hear what an experienced financial advisor who thinks like you do, who takes into account all the macro issues that Jay likes to talk about. They'll look at your portfolio and hear your goals, and they'll just tell you what they think you should do, and you can go off and do whatever you want with that. So yeah, just thoughtfulmoney.com.
I want to dive into that real quick. So I'm looking for a bit of assistance with my portfolio. I can hit thoughtfulmoney.com. I can have a free consultation with an advisor, understand, how they'll engage with me and my money, et cetera. Yeah.
Yeah. I would even, that last part, you don't even need to go there yet, right? It's just literally, here's my situation. Here are my goals. Here are my concerns. This is what I'm trying to do. And they'll tell you what they think you should do. You can take that information, use it on your own as a DIY investor. If you've got an existing financial advisor, you can just give it to them and say, hey, talk to these guys. I like this plan. Let's do this together. Or if you like these guys and say, hey, maybe I could use some of your help. What would that look like? You open the door for that. But I just really want to stress that's not the reason to do this. The reason to do this is just to get some good direction on what they think you should do. And then you figure out the best way to take action based on that.
Yeah. Look, I'm not incentivized to send people to Thoughtful Money, but that's a no-brainer, guys. If you're looking for who can benefit from just a third-party set of eyes on some of the things you're thinking about, right, in terms of the markets in your portfolio, absolute no-brainer. So hit up thoughtfulmoney.com. Adam, look, it's been a blast having you on the show. Great to reconnect with you. I'm looking forward to hosting you in Vancouver in just a few months.
Thanks. It's been an honor to come back on, and I cannot wait to see you in Vancouver.